Okay, good evening, guys. Welcome to this live trading clinic. I'm Steve Ruffley, as you should know by now. Okay, so we've got the Fed rate decision tonight. Listening on the wires and reading, as you do, just the general market commentary. And I think a lot of people are using terms like damp squib and that nothing's going to happen. I like that, to be honest, because if anything does ripple through, then we've got a fair chance of seeing some market movement. We've seen interesting mix of data coming out today. We've obviously got non-farm payrolls on Friday. So it doesn't really matter, to be honest, if the Fed meeting, again, if what is said is unchanged and the bond asset buying back is what the market expects. We're trying to just pick up on some subtle ripples or maybe some tones. Some certain things will go through, and then we can just make our own minds up of how important the rate decision is, but also, again, what's going to come out of the market movement today. So I like it when the market has no expectation that anything's going to happen, because that means people switch off, people think it's a non-event, and people don't trade it. And then they come in the morning, something has happened, and the market's gone wild, but then we've been here to capitalize. I've traded a lot of Fed decisions, a lot of Bank of England decisions, and it's one of these things. When you least expect something to happen, that's when the Fed does something, okay? So the Fed aren't stupid. They know they need to release things and do things when the market's at least expecting it. So this, not saying it will be one of them occasions, but anything potentially could happen. Before I start, as always, I need to read the risk warning. Remember, spread betting and CFD trading carry high risk on capital, resulting in losses that exceed your initial deposit. Maybe so for everyone, so please ensure you fully understand the risk involved. The information comes provided here under no circumstances or offer. Consider no solicitation investment, nothing here to consume investment advice. Information provided is believed to accurate, the data is produced. Again, education only, content webinars posted by the moderator, not intro.com. The content is not constitute financial investment advice or tax advice. Intro.com is not accept any liability for the content content of the session. So we're going to cover live charting analysis, multiple frame, time framing, trading is what I know, fundamental analysis, and live real money trades. You never know, if the market starts to move, we can put some trades on. And again, down to you guys, question and answers, anything you want to talk about fundamentally or technically, let me know. We can go through any product, we can go through any time frame, anything you want to talk about. So today, for the focus for the Fed, it's really on the S&P, gold, and the euro dollar. So interesting today when we saw some data out this afternoon, the quarter-on-quarter GDP expected at 1.2 and came at 0.1. I thought there'd be much more of a reaction in the markets to that. So we saw an initial spike in gold, then a sell-off. I think gold has come back towards the highs. We saw an initial spike up in the S&P and the DAX, and the market actually then sold off, is now towards the highs. And the euro dollar was naturally taking a bid on the back of that on that data. So quite interesting, really, that the market is so difficult to trade the markets. I was trading it this afternoon, and I did my usual kind of Fibonacci retracing with the first 15-minute candle, but the volatility in the markets is just so difficult. I mean, we've got this talk of this Tobin tax, and the market's trying to get rid of high-frequency trading, et cetera, and you can certainly see after fundamental data the effect of that within the markets. The markets do tend to move very irrationally, and that is certainly not good for intraday traders. So will it make any difference in the long term? Probably not. Will it help the banks? Do you know what? It probably will. So all these things, you can't really affect markets. You've got to get rid of high-frequency trading. All you have to do is change the speed of access to markets. That'll get rid of it in a heartbeat. So a tax won't really do anything, to be honest. So it's all about getting rid of people's edge and opportunity to interact with the markets very, very quickly. So really, my rundown for the Fed today is that although the market expects nothing really to happen, there's a couple of key things to me that mean that it's not all as simple as we think. So the first thing is the market expectation. So the market, again, all these very, very clever analysts have suggested that we're going to cut the bond buying program back by 10 billion to 45 billion. So anyone could have told you that. I mean, that's not exactly rocket science. But the thing that was interesting to me is that the Fed have actually had yesterday a medium-term policy meeting behind closed doors. So that's well within their rights. As long as the minutes are released to the public, which will probably be in about 3 weeks, then that's fine. The Fed have the under the sunshine derogative. They can actually meet in within their meetings and talk about things that don't have to instantly release to the market. So when the Fed are having medium-term policy issue discussions behind closed doors, that generally says to me that something's not all rosy. Again, we've seen fairly buoyant job figures, okay, like the non-farm payroll expected tomorrow. We're looking at 210,000. We haven't disappointed in the last two non-farm payrolls, but they've certainly not been as strong as the market expected. I'm expecting probably about 175 from the non-farm payroll on Friday. But again, it's a very, very difficult figure to predict. So the fact that the market's expecting business as usual, the fact that the Fed are actually having closed-door meetings and that we've had bad data today, not just bad data, horrific data, a car crash of data, okay? When you're talking about the quarter-on-quarter, these figures are generally never out of line more than, 0.2, 0.3 max of a percent. We're missing a whole point, yeah? We're missing 1.1 worth of growth in the quarter-on-quarter. So that, to me, means that something is clearly not right. And I wouldn't be surprised if the Fed already knew about that, and that's why there's this closed-door meeting about these medium-term policies. Because I tell you what, once we've got rid of quantitative easing, it's going to be very difficult to bring it back. I know everybody says that the Fed have all these measures, and quantitative easing to infinity. Once you've got rid of quantitative easing and that massive injection of money, the market has to be at least self-sustaining in the short, medium term. If you bring out and take away all the quantitative easing, the market collapses, then all that money's been wasted. So don't just think that the Fed are going to step back in and carry on the bond buying. It isn't going to happen. I mean, there's talk about the European Union doing that. The European Union clearly don't know what they're doing. Okay, they've been following the Fed since the crash began. Mario Draghi's not really done anything to change the situation. All we've done is put a great big sticking plaster, and people have had a little bit of faith in the system and the government, actually know what they're doing. So the market's been bought back up. But I just, to be honest, I don't see that way. I just don't see the unemployment situation changing. I don't see the housing bubble, the housing boom and bust in places like Greece and Spain is over. I mean, that's just over. It's gone. That is not coming back for, generations. And the housing bubble in the UK, well, I mean, anyone that doesn't see it is just clearly blind, because interest rates are going to go up very, very soon. That's why the mortgage conditions have changed in the last couple of weeks. And it's, again, people can't borrow as much as they could. People have to put, bigger deposits down now. But once interest rates go up, there's going to be a whole section of the population which simply can't afford to service the debt, let alone the mortgage. So if you don't think there's going to be a bust, well, there we go. That's your prerogative. But I can't see anything else happening, to be honest. So other things that we're going to look at tonight are maybe some comments about the concerns about the remaining low inflation. Okay, so that's still a concern for the Fed. And, everything's not so rosy in the US either. Month on month, we're down 13.3% on new home sales were this time last year. And year to year, we're down 7.5% on home sales. So not really anything great for me screaming out of the Fed right now. So I don't think that there'll be any change in the rate decision today. I think everybody's expecting that. I don't think that was ever on the agenda. But rates will remain unchanged. But I think anything that happens to the bond buying, if we don't reduce by 10 billion, that would be massive to the markets. So we could see one or two things happen. If you don't reduce it, then you're going to see an initial spike upwards in the S&P, and maybe it'll then come back down quite hard. But and that would be good news to the market. But realistically, what we're trying to wangle out, because there's no press conference tonight, unfortunately. So we're really kind of waiting, filling in the gap until the minutes are released in 3 weeks. So there'll be some minutes from the previous meetings coming out, so that might have an effect. But again, nothing really was said in the last Fed meeting, so nothing really to kind of pick the bones out of and to understand if anything does change, if that will affect forward policy. Really, it's about Yellen bringing some confidence back into the markets. Forward guidance was meant to be what was going to be addressed. He was going to be honest and open. And I think Yellen's found it very, very difficult to understand how difficult Ben Bernanke's position was, because you can't really tell the market a lie, but then you can't really tell something he doesn't want to hear. So unfortunately, it's kind of one of them. We've got nothing nice to say nothing at all. So instead of having clearer forward guidance, all we've got is this uncomfortable silence where Yellen says, yes, we can act whenever we want. We've got other measures and policies. And that doesn't bring any confidence into the market. So, yeah, what is going to happen today? Well, we just don't know. That is the whole point. So what we'll do is listen to what comes out from the previous minutes. We'll see if any kind of key moves are made in the market. Going to focus on the S&P and gold, I would say, today. Euro dollar, again, we're towards the highs, so we could have a very, very nice Fibonacci retracement here, to be honest. Once we've kind of rejected the upper levels up here at 1.38765, we're really holding on the pivot now. So if anything bullish comes out for the US, then we definitely see the euro drop down to 138.552, 138.442, and maybe lower. Again, we've got a lot of targets on the downside, that is for sure. Gold didn't really want to sell off, didn't really want to go up. And we've kind of found a little bit of short-term support, and then the bad news has filtered through and overridden, and we've touched the top end of the Bollinger Band. So realistically, gold can get as high as, in normal technical trading, 103, 160, 1305, or 1307. Unless something big comes out from the US, I won't see a move higher than that. S&P, doesn't really matter what happens, does it? Every time you look at the charts, unfortunately, the S&P seems to be higher. So there's still dip buying in the markets. There still seems to be this underlying confidence that everything's fine. So if you do start selling the market, make sure you've got a tight stop in, because, again, I think a lot of people have been caught short selling the main indices. That is for sure. Okay, Eric, well, the interest rate is going to be unchanged. That is for sure. So it's really, we see anything to do with forward guidance, or we see anything to do with bond buying issuance. That's for sure. Okay, guys, have you got any thoughts yourself? We've got 3 minutes or so before the release. Has anybody got anything they're particularly thinking? Has anybody taken a position prior to this release? Has anybody got an inkling of what could happen? Again, is anybody trading any different currency pairs, or has anybody got any different bias? Again, I like to look at gold, because gold is still very, very volatile over these figures, and the S&P, obviously, this directly affects the US economy. And the euro dollar, there's still rumors that China are buying huge amounts of euro and liquidating dollars. So that's really the only reason why I can understand why the euro is so prone to these bounce backs. I mean, again, we're getting towards the 140 mark. Is the value in the euro up there? I just don't see it personally, but there we go. Okay, John, good man. He's gone all in, selling the S&P. I like that. Which currency do you think will get the highest spike? Well, anything dollar-based. So maybe look at the dollar Swiss. The dollar Swiss is always a good one when you're looking at the dollar and people getting out for safety. So the Swiss would be one for me. Okay, so we've seen a lot of shorts. Short on the pound versus the dollar, and the New Zealand versus the US dollar. Okay, well, interesting, guys. So we're expecting some positivity. It looks like, really, to be honest. So you're short the euro dollar, watching the lower fib levels. Okay, well, absolutely. I mean, it's this 50%, isn't it? That's the key now. That 1.386 level is certainly a big pivot here. Well, I mean, again, we're expecting a bit of a non-event, and that's just the market commentators. So, you could be fairly safe taking a position either way, to be honest. But that's not my style. I don't really look at it that way. So I'll be trading probably the S&P, to be honest. So anything that comes out, I'll just be trying to get on the back of that. And again, we'll do the usual. We'll call out the levels and see what happens. Okay, guys, only a minute now. So a minute now till we find if the rates are unchanged and the bond back. I'll listen to the squawk and I'll read it out to you. And if I see anything big, I will tell you. So it'll be a bit frantic if anything new comes out, but we know that. So the call will be, obviously, rates unchanged, and then I'll tell you about the bond back buying issuance. 15 seconds now. interest rates low for a considerable amount of time. So again, seeing more weakness come into gold now. Labour market is improving. So generally good news here. So the S&P is dipping back down. Maybe some opportunities to buy. Gold again has tried to test that a little bit lower. Well, there we go. Pretty much as expected, nothing majorly coming out of the market. So we've seen gold try to push its way down, and now the S&P again is looking to make some new highs. Again, we're seeing more of a bid coming back into the euro. So the euro is taking that news fairly positively. Interesting, bit of a mixed bag of fish, though. To be honest, don't really see anything unexpected from the markets. Well, we taper as usual, and the underlying rate is unchanged. But again, the market and the Fed and Yellen are trying to talk up the positivity. They're not saying anything about the GDP today. They're not saying anything about tomorrow's non-farm payroll. They're not saying anything about the housing stats being down. Again, you got to think about the words that they're using. You know, all these underlying that we've still got highly accommodative stance, that we're going to keep interest rates low for a considerable amount of time after quantitative easing has been tapered. So we're still going to carry on tapering, it looks like. So that realistically, we could interpret in two ways, that it's what the market already knew, but it's almost like reaffirming that quantitative easing won't be in existence after the next kind of 3 or 4 meetings. So then again, I mean, is that positive or negative? I mean, it's got to be fairly positive. But I mean, look at gold. I mean, that's why it's so difficult to trade gold at the moment. We've just seen gold absolutely, tank down very, very quickly, 33 ticks. So you could see these highs broke now. You could see definitely 103.01 spot 60. You could see a quick spike up now, and then that's definitely the target. Gold has a nasty habit of doing this. Well, I mean, there's only so much they can blame on the weather. To be honest, I mean, they said about the weather for the non-farm payrolls about 2-3 months back, but then the revision came in the same. So it wasn't anything to do with the weather at all. So yes, obviously the GDP will have a negative effect on people's spending. But after that, the quarter on quarter, people have still been out buying things, doing repairs. Anything that has caused all that disruption will ultimately, have a positive effect. People will just buy more stuff. So you can't really keep blaming the weather for the US's problems. It's more deep-seated than that. The US is just purely not stimulating enough internal growth. It's as simple as that. You cannot continually blame natural weather and natural occurrences for things like that. So really, we're looking again to make a bit of an attempt higher in the euro dollar. So again, we've got the break points here. I mean, it just looks strong. The euro dollar just looks strong. I hate to say it. I wouldn't always sell tops, but it just does look strong at the minute. Gold again has hit that top fib level here at 1298 spot 20. And again, I think ultimately that was positive news. So I'd expect gold to try and test these low levels of support down here and at least get back down to 1287. I mean, you've got to kind of marry up what happened this afternoon is what the Fed said, keeping rates very, very low, ultra accommodative, all these kind of things. Gold's on a natural bear market and has been for the last kind of 6 months. Is that going to override the bad GDP that we saw today? Eric's just saying euro sell or long. I'd be looking for a break. I'd be looking for a long the euro, but I'd be very, very careful. I mean, again, watch for that 50%. This is the key pivot here. So maybe let's just switch back down to a smaller time frame. Okay, so sorry, let me just go back to that hourly. I'll just indicate that line for you. So this is the pivot for me now. So again, we're in a fairly tight range, the top of the range of the 15 minutes. So I'd expect a break, and I'd expect the euro to move higher from here. Gold again, I'm not expecting anything from gold, to be honest. But it just looks like, this double top here can't break the 100% retracement. It looks like it wants to go lower. In the S&P, well, it doesn't matter. It doesn't matter what's said at the US. It gets bought up. So if you see a break, we're heading to 188 spot 20. That's for sure. Okay, just going to answer questions here. Hi, Steve. The question got lost in the mix earlier, so sorry for posting it. No problem at all. You've been noting the GU can't close daily above 16825 throughout the long spikes, which could lead me to believe the players want to show some US dollar strength in the coming weeks, going to 170. Not sure this week any trigger, any comments. Well, I mean, the trends are the trends, and what is happening within the markets. I mean, we can all talk about these, these big players and the big currency firms, the big hedge funds, and the brokers, and it doesn't really matter, to be honest. The markets are so big and so fluid that what is going to happen is going to happen. I mean, realistically, the dollar is going to remain strong. Okay, I mean, the US is trying to stimulate its economy, through its growth. It doesn't export enough. I mean, again, it's trying to be competitive with China, trying to be competitive, with other nations, but it's really at heart a consuming nation. So it wants its consumerism to be bolstered by internal buyers. He's not interested so much about external money coming in because it is the biggest economy in the world. So the dollar strength is in some respects good. But when you come to talk about dollar strength, you have to understand that the dollar brings all these measures in like quantitative easing because it can't really realistically control its own currency rate. It's not like it doesn't have the reserves that China, Japan, even countries like Norway has. So it can't control its currency on the open market. So what it does is internally create these very aggressive policies that bring demand, that bring changes within the dollar, from the outside world. So it's difficult to say. I mean, the US has got a plan, but how solid is this plan? I just don't know. Well, I mean, the euro now, it's kind of rejected that, hasn't it? We haven't reached the higher levels. I mean, it's due a sell-off, but again, I mean, the markets aren't really doing anything, are they? This again is just another example of no one bull section or bear section taking a particular bias either way. So we've tried to make the highs and not held on to them. You've tried to hit the lows, not hold on to them. Gold is what I said is looking bearish. So if we break these lows in gold here, we've certainly got, I would say, 30, 45 ticks on the downside. And the way gold is, we could open up. We could do that in 15 minutes. So I wouldn't be selling the euro dollar right now. And I don't think I'll be buying any dips in gold. I mean, this is one of these real situations where you can get turned and burned. You can just get caught in the mix and nothing really can happen. So what do you guys think? Anything? So Alan's just saying, shake, shake, shake. The market's right now, end of the month, highs near the end of the day, a good chance to clear the books. Yeah, I mean, again, that's certainly one way of looking at it. I mean, that's definitely. It'll trap people at both ends. Yeah, I mean, that is exactly right. That's what I've just said. I mean, Alan's hit the nail on the head there. We're really just ranging in 30 ticks of a market. There's no real opportunity to take a position. So all we'll be doing is literally taking a bounce from the highs and the lows and looking for that short-term move. If anything, wouldn't want to sell the euro, won't particularly want to buy it. The only thing I'd like to do is potentially sell gold below this short-term break here because I could see momentum come in and the market really push down to this 1287 level. That'd be the only thing really for me that holds any particular interest. What about GBP? Yeah, we can look at the pound. Again, seen a nice move upwards. We've hit the top end of the fib. So really, again, 1.68730 is really the pivot point here. We've closed again on the hours within the Bollinger Bands. So naturally, if the market can't make some highs against the dollar, then cable is going to test back down lower. And you'd say 168481 is really the natural point of where we want to come back to. Ties in with near the moving average and these short-term resistance points. We seem to be very overextended in the pound versus the dollar today, that is for sure. Andrew's asking, the ATRs in Forex are down massively over the past few months. It's really incredible. Yeah, absolutely. I mean, the trading ranges are certainly down, but again, that's because we're seeing the volatility, but we're not seeing one particular section of the market win or lose. So if a market goes up 100 ticks, then it'll generally come back down very, very quickly, 50 ticks. So we're seeing more consolidated ranges, but with more volatility within that. And that's just a sign of the times. That's just a sign of people not knowing what is true value. And again, that's what the Tobin tax and all this Robin Hood tax are talking about is the markets aren't behaving efficiently. People aren't invested in the markets. All they're looking to do is get involved in the market very short term. And that's what's causing this massive amount of volatility. So interesting. It's an interesting topic, the Tobin tax. When I did some more research and went into it, it's quite a complex issue. And certainly I don't think there's any easy way to solve people's attitude to risk and to how people perform in the market. Okay, Eric's asking, what do you think of the dollar strength right now? Well, to be honest, I've always said I would always sell the euro and always buy the dollar. The dollar's the world currency. Everything, commodity price wise is priced in dollars. So why would you look to sell? The dollar's going nowhere. Again, if the US can't pay the bonds back, then it's the end of the world, pretty much. So what does it really matter? The US, under no circumstances, are going to ever default. So there's always going to be a demand for the dollar. Not saying it won't shift. Again, if China are looking to liquidate large positions of dollar and buy other currencies, fine. That's completely within their right. But to be honest, you're not. While we still have a kind of civilized world, then the market really is always going to demand some sort of dollars. So that the strength will never truly go away ever. Okay, George is just asking, do you think that GDP today was a structural result? What exactly do you mean by that, George? Do you think what he's saying that the figures were manufactured, or the figures were somewhat changed for the Fed's benefit? How exactly do you mean by that? Again, this could be a point where the euro finally decides to break lower. Again, we'd have to wait for 3 minutes, for the market to tell us anything really. That's just, an indecision candle on the 15 minutes. We're not really seeing anything strong at all. Let's just check back and see what gold is doing. So there we said, like I said, gold is the one I'd want to be selling. So we just picked through that short term. So the support 2 and 1282720 could be a good target. Might be a nice little cheeky bounce if you want to buy some gold down there. But remember, again, the actual trend for gold is down. So it could really look at these targets for break rather than bounce. Okay. Let me just go back through these questions, guys. Sorry. George is just saying that there's no coincidence due to weather, etc. Okay, well, none of these things are a coincidence. The data is the data. Again, the market could have moved quite aggressively on the back of that data and chose not to. The market's headed higher. So really, remember, we've got non-farm payroll, which the majority of people are much more attuned in and want to take on risk with. So maybe everyone's just taking the non-farm payroll and taking a bit of a breather after this GDP. But I don't know. It's very, very difficult, isn't it? It's very difficult to interpret that bad news is still good news in the US. But hey, the markets don't want to sell off just yet. And when they do, people will probably find it hard to sell them. Okay, Helmi's saying, I have an old short position. What do you suggest? In what product have you got a short position in? Okay, Will T just asking, hey Steve, can you take a look at some CAD crosses, recently broken structure? Yep, absolutely. Let's look at some CAD. So dollar CAD, let's just go through the time frames a little bit. So monthly. 1 second. Yeah, monthly. Again, you can see a very nice wave happening, but the best thing to do as always is do your Fibonacci. The downward starts here and we bottom out here. So you're looking for that 50%. Well, we've hit the 50% and closed below in the monthly. So realistically, until we retest that 50%, it looks to me like the market's going to move down. So if we just cycle through the time frames, this is the weekly look. Then the weekly looks fairly bearish to me. Again, the moving average has acted as support. Bit of a doji here. Market's, a bit of indecision. So realistically, I would say that we're going to start seeing some weakness in the dollar. Really, we're going to see some selling down, and your key levels are are certainly down here. So I'd say if the market does continue to move lower, we're going to see 107,955, 106,555, and to 106,057. So a good 350 ticks on the downside. Again, if you look at the dailies, again, looking fairly bearish to me. We're making lower highs from here. The market hasn't really again been able to make any inroads upwards towards these higher fib lines. And again, that's how you have to look at these things. I mean, look, when you go on the monthly, weekly, daily fib positions, it's amazing to see, how the higher time frame levels work. So realistically, your levels are here. And here, realistically, for your channel. So you'd expect that the market's going to do one or two things from this point. It's either going to continue this down momentum that we've seen from this big sell-off yesterday. The market has got 200 ticks on the upside, but realistically for me, we've got 140 ticks on the downside. We're closing below resistance, so support, a break of the lower Bollinger Band on the dailies, and we see 108.030. So we want to shore it up, put some more indicators on. I'd always recommend looking at some relative strength, 14 period, nice and simple. So again, holding below the 50. We're not anywhere near the oversold territory, really, to be honest. 38, they've got 30 and maybe 20 for an oversold period, so plenty of room on the downside. And again, put yourself something like the demarker is good for bull-bear reversal. Okay, so on the dailies, again, we've rejected the bullish move upwards, so bear reversal's kicking in. So we've got all this distance here, like the RSI, before we get into the oversold territory. The bulls come back in. So for me, that's spot on. Realistically, what we're looking at is we've got the peaks and the highs in the market confirmed. Okay, we're inside the upper Bollinger Band, broken and closed below on the daily, the moving average. So realistically, I think we've got 139 ticks to 281 ticks on the downside. Okay, so down, sell the dollar CAD. That's what I would say. Does that tie in with what you were thinking? What do you think, Thomas? I mean, are you bullish, or are you going to be buying some dips, or would you say we've got further downward movement from that analysis? Any thoughts there? The shorts on the euro. Okay, Helmy. Well, I mean, again, my personal view is that, I would remain short the euro when we've hit the highs. But unfortunately, with the euro being so strong, you never know where them highs are going to be. So I would only be short while the trend is still up for a small amount of time. So I'd look to sell very, very high extremes and get my position out. And what I wouldn't do is hold it overnight, because with the euro being so buoyant and having big players in the market, you can quite easily take a short position and the market can move very aggressively against you. So I'd only hold short positions intraday and only hold them for short-term bounces from the highs. I would not take a long-term position short on the euro. So hopefully that answers your question. Thomas, yep. Okay, bearish, yeah. Yeah, Andrew, yeah, well, absolutely. I mean, something can remain oversold for months, but we're on the dailies, aren't we? So, the dailies can't remain, well, they can remain oversold for a period of time. I mean, you're looking, for a period of 10 days here before the market then hits the lows and comes back up. So, yeah, absolutely. We're not talking about things happening right now. If you want to look at what's going to happen right now, I'd probably look on the hourlies. Then you can start to build up the same kind of picture. Okay, so the hourlies really, again, we've made, we're looking a little bit more like we want to push higher. Okay, but there's nothing to say we won't get back to the 50 and then move down. So it's trying to preempt what these curves will do, in between. So the demarker, again, we haven't finished getting towards, the bull reversal. We haven't finished getting towards, the end of the selling cycle. So until we kind of hit this point and reject it, the market still wants to move down. So again, we can do anything in the RSI, to be honest. I mean, the RSI can be easily manipulated. We could go up quite steeply and then come down. But again, I mean, I don't know what you want from me. I haven't got a crystal ball here. You know what I mean? I'm just telling you what the charts are telling me. The market has rejected on the hourlies and it has moved all the way down to the lowers. So in true Bollinger Band style, if we're going to continue, then we could quite easily, on the hourlies, test the upper Bollinger Bands again, which is, 21 ticks, and then move down from that point. So it depends what your risk reward wants to be. We're a lot closer to the downside than the upside. So take your pick. I mean, it makes no difference to me. You can have 20 ticks, 25 ticks of risk shorting it, because if you break outside the Bollinger Band, then you probably get out. And your 25 ticks would buy you a potential of 143 ticks, or you take your 143 ticks on the downside potential to make 270. That's the way it is. That's the way it works. So you got 25 ticks to make 140, 140 to make 250. That's the way trading works, I'm afraid. So I can't tell you anything else than that. The risk reward is you go short now, using that Bollinger Band as resistance, and you hold on until the market sells off to where it naturally is going to get to. That's higher time frame trading on lower time frames. So you've got 25 ticks for a 5-to-1 risk reward, or really a 2-to-1 risk reward of 120, 30 ticks, to make 250. So I know which one I'd rather do. And again, I mean, it's, we've had bad news out of the US with the GDP. So depending on what could happen to the non-farm payroll tomorrow, if you see less demand for the dollar, then it's going to obviously be pushed down, against the CAD. So that's just trading. Again, it's just that's how I analyze things. You've got fundamental reasons there, you've got technical reasons there, and that's what that is. So I can't, again, I can only go through the time frames and tell you likely scenarios. It doesn't mean you should buy or sell now. But go away and pick out your own charts. I mean, I've just put basic indicators on, guys. These are standard MetaTrader indicators. So DMarker and RSI are there for everybody, and they're not. I haven't set them to anything different, and they're not anything particularly amazing. The other things like the lines and the things I have running, are a little bit more complex. But realistically, I've just shown you from the monthly chart that the boundaries are here and here for the fibs. So we're below the 50%, which means higher time frame we're negative. Okay, we're coming down on the hourlies, we're coming down on the RSI, coming down on the DMark, down, down, down. So I would rather sell for 25 tick stop downwards than I would buy. So that is just the analysis. Okay, what else have we got then? So no such thing as oversold and overbought. What that means is simply it went lower, higher than I thought it would. Yeah, I mean, it depends how you interpret it, Alan. I mean, overbought, oversold, bull reversal, bear reversal, they're just indicators to tell you that a particular trend is coming to an end. So you can either sell all the way down to the bull reversal and buy the way up to the bear reversal. You can do whatever you want. I mean, trading's individual to everybody, and technical analysis is difficult to everybody. The thing I teach and the thing I'm very successful at is building people a reliable strategy. Because how many times do you see a chart and go, I knew that was going to go down, but didn't sell it? The reason why you didn't sell it is because you don't have enough commitment. So you don't have the right trading strategy. So if I say to you that if we close significantly below the 50% on the RSI, we close below the 50% on the DMarker, okay, and we see that we're below the 50% on the higher time frame fibs, we've got more room on the downside than the upside, then what you're looking for is a breakout and a sell to the downside. If I say it like that, then you're much more likely to sell it than you are to buy it or do nothing. And that's how you build a strategy. So all these things are just confirming indicators. As Alan said, you can just look at the candlesticks to know it's going down. There are more big red bodies than there are green. Therefore, there are more sellers in the market than there are buyers. Okay? Not rocket science. Do a Fibonacci if when the move starts low to the high. Yeah? Don't get to the 50%. Okay? What happens when we don't get to the 50%? Make a new low. Okay? So we're going to make a new low just here. And when we do, we're probably going to break down aggressively. So your next target is here. Simple as. I mean, I don't know what else I can tell you. Probably, it's going to absolutely rock it up now and prove everything I've said wrong. But I doubt it. Okay, so I'm expecting highs at 1.40. Euro highs, yeah. Okay, we'll go back to that in a minute. Thomas is saying, started to sell on the US dollar, CAD at 110, but seems to be more room downside on the dollar CAD. Yeah, I mean, right. Okay, I can kind of see that. George is saying, how do you see the Aussie dollar long term? Everyone loves to ask about the Aussie dollar. Stop buying the Aussie dollar. Okay, I mean, we'll go through it in a minute, but I mean, the Aussie dollar seems to be one of these that everyone's looking for the bottom in it, and it just keeps going further down. So stop buying it. It doesn't want to go up. Again, I mean, look at these scenarios. Every time we start to, come back up. It wants to come back down. So yeah, all the value was bought down here and down here. I think for me it's out of the markets now. So I think it's only going to continue to come down personally. And again, look at the charts. We're not on the bull reversal point just yet on the dailies, but we're certainly coming down. When we've made lower highs in the RSI, so it just looks bearish. But I don't know really. If you look at it from the weeklies, it looks like it's done as much as it can, and now it's looking to test lower and get back to the moving average. So the dailies again, although we bounced off the bulls very nicely, until we close above the moving average, there's still going to be more selling momentum in the market than buying. So that's how I see that, to be honest. So longer term, I down, definitely down. Okay, someone just telling me my gold worked well. Oh, well, there we go. Surprise, surprise. Well, we're yapping on about the Aussie dollar and the Canadian dollar. Gold has done what I said. Again, I probably wouldn't buy here just yet. I'd let it touch through to 128.720. That might be a little buy. But again, if we don't bounce back in gold, then we're going to hit 128.7, and quite easily, gold's aggressive. We could see gold break down to 127.750. So we might see another point, another 100 ticks or so knocked off gold. That could be shown. I said gold was really the only thing I was particularly interested in looking at. But you can't win them all. Let's just go back to the euro dollar. So the euro dollar again, it's retracing. It's bounced off the 15 minutes. So everything from the Fed now is priced in. So we're still bouncing off this 50%. So realistically, we close with 138.658. We make a new high. Okay, we're making a new high in the euro dollar, and the highs are all here for you to see. Could get to 139. Okay, 139.050. That could be where the market spikes to. Because all you have to do is look at the fib of this hourly move. Okay, we're not getting anywhere near the lower fibs. Nowhere near the 50. Nowhere near the 38.2. Nowhere near the 23.6. So the market's going to sold off by now, and any news, it'd have done it by now. That means the longer it holds above these levels, the more chance we have of making a higher high. There's an 80% chance if we don't close below 23.6 that the market makes a new high. Might only by one tick, but it will have to make a new high. That's how Fibonacci works. It's an 80% tool if you use it in the way I do. Okay, what else have we got? What do you think about the Aussie New Zealand dollar dropping to 105.5? You have a sell on the Aussie at 107.31. Let's have a look. Aussie New Zealand dollar. Well, on dailies, it's looking very negative, isn't it? We can't really deny that. Look at the wicks on the top every time. This doji here, big sell-off, market gets back. But doji, again, this market's really, struggling. A lot of wicks on the top side. So on the hourly chart, again, this is where it's very, very difficult, isn't it, to get the confidence to sell, because you think, well, we're hugging the low end of the Bollinger Band, that, we're going to see a bounce back up. But when you see so many red candles, what you'll generally see is consolidation. Then instead of a retracement back up to this 107.965 level, the market will continue to sell. So I would say realistically, let me just clear that up. Realistically, we're going to test 107.623 and 107.345 before we see any bounce. So don't be fooled into dip buying anywhere down here, to be honest. They might look for the market to do the opposite of what you think and overextend. So realistically, before I would be buying, I would let it drift another 38 ticks or so before I considered buying, because the market can quite easily push. Because we've really sold off, and we haven't retraced any of this yet, have we? To any significant amount. We had a good try here, but closed towards the bottom on the hourlies. So for me, that indicates much more a bearish bias in the market. Nothing really below that until 106.280. So if you're going to buy around 107.345. But for me, sell, stay short. Stay short. That's all I would say. What do I expect the non-farm payroll to be? Well, it's kind of expected around the 210 mark, and I'm more primed. I said an FX Street in my analysis yesterday that I'm more of a figure 175. I'm not expecting a downward shock, to be honest. I'm not expecting a terrible figure, but I'm not expecting a great figure. The trend for non-farm payrolls has been pretty much within 20, 30,000 of the market expectation. So I don't expect anything to be that different this time around. So 210 by the big boys like Bloomberg and Reuters. I'm punting for a little bit lower, and I think a figure 175 for me, but I don't think that'll do very much to the market. But yes, I believe non-farm payroll 175. Okay, Alan thinks it's 180. Well, if Alan thinks it's 180, then we're in good company. No worries. My pleasure, Thomas. I'm glad you like that. What else have we got? Yeah, I'm with you, Alan. To be honest, I don't think it'll be. I think it'll just be a good figure, as in there'll be jobs created. I don't think it'll be anything to write home about, but I don't think it'll be a shocker. I don't think we'll have, like a sub 100 figure. Where was I for the GDP release webinar? GDP? Oh, sorry. Yeah, there's a slight mix on times, Alan, to be honest. So I did join later on, and we did. Some people made some money on the fibs on gold. But yeah, I just had had a little bit of a timing issue there. I've got a lot of trouble with that right now. I'm doing so many kind of webinars, and we're on Mountain Time, GMT, BST, that if people put things in the calendar wrong, then I just miss them. Before when I only had a few webinars, it was easy because you only had a few. But now I've got so many. I have to. People have to put them in the diary at the right time. If they don't, then I'm obviously doing other things. So apologies for that. So 175, 180 would be a bad, especially the GDP data. Well, I mean, you can look at it that way, but the market's not really sold off, has it? It's had an opportunity to sell off on the GDP, and it hasn't. So if the Treasury is still, buying stocks and pushing them up maybe. It's just difficult. I mean, sometimes you have to trade the fundamentals for what they are and literally trade them for a 15-minute or an hourly candle. If you try and build a position out of a fundamental trade right now, you generally get punished. I mean, when all this stuff kicked off before the Easter break with Russia, I knew Russia were not going to play ball, but the markets, opened up on the Tuesday and rallied up. So I had to get out the short, and then the market sells back off. So difficult to turn a fundamental position into a good, solid technical trade and something to hold. So my advice for everybody would be really just try and get your money out of a 15-minute, an hour, or maybe just hold your trades for a couple of hours. Don't take any undue risk. It's just too volatile, just too difficult, to be honest, right now. So again, the S&P, as I say, it's looking back to make them highs. As I said, we've broken through and tried to head for the 188 and 188 spot 20 mark. We're not finished yet. So yeah, bad GDP or not, the market seems to be taking whatever the Fed and Yellen have said as fairly dovish, and we're looking to make new highs, I would say. So massive level up here, 188 spot 20. So I wouldn't be surprised at all if the market, plips up another 48 ticks or so and gets towards there, which could then see gold push further lower. But I don't know. Yeah, bought a nice gold dip and made a nice bit of money on the way up. Nice, good. Well, that was probably the safest trade, to be honest, Alan, because there was a big spike up in the indices and then they finally did sell off. But gold had a good solid bounce, so that was certainly the trade. And that's again when we focus on anything like the GDP, non-farm payrolls, or the Fed decision. It's always good to have gold up because it is so directional for short periods of time, so you can actually get on the back of a move and have some confidence and make some half decent money. Well, it's never the same without me, Alan, is it? It's never the same without me. The world would be a lonely place without Steve Ruffley. It would. It'd be cold and lonely. So Thomas is saying, with everything taken into consideration, do you see the dollar Swiss approaching key psychological levels 90 and the US dollar towards the 105 over the next month? We've seen the commentary suggest this. Yeah, I mean, I've said in previous when I was being interviewed by Dale Pinkett that I thought the dollar Japanese yen get to 105. And as for the dollar Swiss, well, let's take a look. I'm still fairly bullish the dollar, so I'll be still selling the highs in the euro dollar. But again, I mean, sometimes if you're just getting something wrong and consistently call it wrong, stay away. So if the euro continues to make its high and it's not going down, I'll stop selling it. I'll just trade something else. Don't Einstein's theory of madness, doing the same thing over and over again, expecting a different result. Like the S&P, if it's not selling off, stop selling it, buy it. Okay, I know where the levels are, so I know where it's going to go to. Let's get the dollar Swiss up. So, I mean, we've still got, a long way to go to get to the 105 level. But 105 spot 440 is certainly a big level. 103 spot 732 in the dollar yen is where the market wants to get to now. But, maybe we've hit some lows. I mean, the daily's really, we're still on the way down. But I mean, if you look, a lot of these wicks are still saying there's buyers in the market. We've been hugging the moving average. And although we rejected the upper Bollinger Band, we're still using that moving average as some sort of support. So until we close below 101 and obviously the psychological level of 100, I would say that if we start getting some good bounces and break through this key series of support between 102.723 and 102.856, then 105 is certainly a possibility. So again, if you're looking from a risk-reward perspective, if you take from the low a 60-tick stop around about 101, then your upside is 330 ticks. So you've got a 5-6 to 1 ratio of your stop to risk reward if you want to go long into that. And I would say that would be the trade for me. I generally don't hold trades in the euro dollar overnight, but that's maybe what you have to do. But that's the risk reward. You've got more potential upside in these targets here than downside, personally. Well, that's just the way I interpret it. Dollar Swiss, really the same kind of scenario, to be honest. When the charts look, amazingly similar, don't they? So realistically, we start holding above 0.88023. Then again, we've seen the wicks. Then we maybe start to see some, the support kick in, and then the market retest these levels up here at 0.88688, and then maybe we get towards psychological levels at 90, as you say, and then the weekly level is 0.90221. So that would be really where the market would, for me, try to go up. So again, if you're looking for a good trade, you've got 57 ticks or so, really maximum downside to prove you right or wrong. And then on the upside, between 99 and 150 ticks on the upside, maybe even 220. So there's still a lot more potential to buy and be safer than to go short, I would say. But again, that's just my view. Yeah, absolutely, George. But you have to remember that correlations and coefficients do change. So, it's very difficult. Look at your coefficients on the smaller time frames. The historical coefficients have not been acting or playing particularly well, to be honest. Do you find the euro dollar easier or more difficult to trade since the bankers say they were all where all the dumb money is? Yeah, I mean, it's one of these things, Andrew, isn't it? I mean, it's easy for bankers to say whatever they want because, well, your average trader, and I class myself as that, can hold a 20, 30, 40 tick stop. Banks can hold hundreds of ticks and average in, pretty much to infinity. So it's very easy for bankers and these kind of people to take positions and release comments into the markets. But, if you're intraday trader, it's quite difficult. So as I say to you, when the market runs out of momentum and we don't find any more buys in the euro, then I sell it. I don't want to be buying it, although that's the safest trade. But I understand what I understand. I know what I know. And I trade what I trade. So I don't want to buy the euro. I want to sell it. So I sell it when I think it's run out of momentum. And if it doesn't look like it's run out of momentum, I stay out. So the art of trading and being trading for a long time is picking your battles. So if you're consistently selling the euro and it keeps going up, stop doing it. Yeah, either buy it or stay out. There's $4 trillion traded every day on the currency pairs. It's not all in the euro dollar. So good comment that Andrew. But I would have to say that, smart money, I don't know. The smart money would be in property 20 years ago. So it's very difficult to say where smart money is right now. Yeah, I mean, it is. The euro dollar is very boring to trade, to be honest. I agree with Alan. There's better markets to trade. There's better correlations, better coefficients, better things to be. I generally use the euro dollar as a bit of a trigger now. So when it's going up, I can look to sell other dollar pairs. That's what I look at, to be honest. If I don't understand how it trades and I don't like it, I stop trading it. That's the benefit of being a spread better. We can trade anything we want. No worries, Thomas. Getting a few laughs. Good. Well, that's nice. It's good to laugh, guys. It doesn't always have to be serious, these sessions. We're here to exchange ideas, get together and talk about what we're trying to achieve. So, it's good that we can look at things objectively and, everyone's opinion is valid. Just because I say something doesn't mean it's going to happen. I mean, unfortunately, nobody has the answers, and unless you're George Soros or people like Warren Buffett sat on billions of dollars, what realistically can we do? Let's just go back and check out what gold's doing in the S&P. Well, there. Okay. So yeah, still looking strong in the S&P. I mean, again, if it ain't broke, don't try and fix it. Dip buying seems to be the order of the day. We've seen a nice bounce off gold from that, to the short-term support level, but I still think that's bearish. Still kind of winging away near the tops in this euro dollar, but realistically, that could be the top there. I mean, again, easy for me to say, but if that is the top, and that's where again the market has found out. Watch for a break of 138.552 and try and let it get back to that 50%. So if we close again below this red fib line here at 138.765, then you've got a downside target really of I'd say a good 30 ticks or so. So maybe if you aim to make 20 ticks, then that's a fairly reasonably safe trade. But again, we can see a quick spike up. Maybe the market doesn't want to do that. Maybe these clever bankers are going to push it really quickly to 139.050 level and then let it come down. So it's very difficult when you're picking a top, isn't it? Because tops can be broken very, very quickly. We have closed inside the Bollinger Bands quite a few times now on the hourlies. We've got a double top now on the hourlies. So I would say if the next candle opens red, there could be a nice short trade down to these lower fib levels. And they kind of tie with my green fib levels, to be honest. So that looks a fairly reasonable trade to me. Well, I mean, that's the thing, isn't it? You're going long for the break, you can go in short for the short. I don't know. I'm just telling you trade ideas. I've told you that I would not be buying into the euro dollar anyway, so my bias would always be short. But I'm just looking at the charts as you are, guys. I mean, there's nothing for you to say you've got a different opinion than me, but I'll only tell you my honest opinion, and I wouldn't buy it, even though there could be a potential break. But again, I'd be more happy seeing this stay as a double top than then seeing a slower grind down back to these lower fib levels. That's what I'd look for personally. Yeah, I mean, again, when you looking at these particular type charts, I'll just show you again. I mean, this is a blank chart, so my Fibonacci's are generally drawn differently than most people. So maybe I've got a Fibonacci, like this. Okay, so again, that looks pretty nice to me, to be honest. That's what potentially could happen at a time with other levels is the market could break through and we could see 60 ticks on the upside. If we see a double top here, then realistically, I can see that the market will get down to 50%. So as I said, 26 ticks, I'd be looking for no more than 20, 25 ticks out of a short trade. And again, it'd have to be that we see this double top remain here, the market then come back down. I mean, you build up your chart in any way you want. So, you can put whatever you want in. Put some Bollinger Bands, maybe 20 period. Okay. What else could you put in? Again, put in your RSI maybe. So if you're just taking your chart from nothing, then, you can start to build up your own picture. When the RSI was peaked out generally about here at 78. So we're looking like we are, getting towards a high and coming back down to the 50. Again, we see this double top remain, then the moving average is on the 50%. So that's it, really. If we break above, then maybe that's the bankers getting everybody who is short out and pushing it up as far as 60 ticks, and it comes down to the 50%. So to be honest, guys, it's one of these things. I won't be looking for much more than 25, 30 ticks out of this move, and I'd be looking to close continually inside the Bollinger Bands and then sell off to the 50%. And then, to be honest, it'll probably bounce and go back higher because that seems to be the trend right now. But, that's just that's how I do a chart. So my fibs will look different than yours because my fibs are generated on previous history. And that's just the way it goes, guys. So, anything else, guys? Anything else? It seems to be a lot of talking in that session, to be honest. Anything before we wrap it up? Yeah, demarker and RSI are general things that I look at. They don't really play any part in my my Bollinger Bands and my kind of Fibonacci setups. My charts are fairly simple. It took 10 years to make them that simple. To be honest, guys, it's not an easy thing to do. It's based upon many different higher time frame ideas and very specific intraday measures, in order to get that balance right. The negative recent correlations of treasuries and dollar. I mean, you have to think. I mean, the trouble is, right? All this government debt is priced in dollars. So when you're liquidating huge positions and you're reducing bond back buying issuance, the correlations aren't going to be there. Okay, so the correlations in normal markets are that stocks go up, bonds go down, bonds go up, stocks go up. Okay, the correlations are that gold is a safe haven, the Swiss is a safe haven, so they go down, S&P goes up. Yeah, these correlations just aren't there at the minute. So the treasury and dollar correlations are not there because we're in artificial scenarios. So as I say, the market S&P is making them new highs. So 188 for spot 10. With somewhere we'll look to test. If we break through that, 188 spot 20. Okay, that might put a little bit more of a bit of pressure on gold, and gold might continue down. And maybe that will be good for the euro dollar short. If we do see these new highs in the S&P, maybe then finally we start to drift back down towards them lower levels. Okay, guys, we'll take a screen print. Okay, take a screen print. Press Control Print Screen now and paste that into a Word document. If we break 1884 spot 10. We see 188.820 in the S&P. We hold below some of these key levels, like maybe 1292 spot 40 in gold. We get down to 1287 spot 20, maybe down to 1277.50. Hey, who knows? And again, if we don't really significantly close above here, we can break it, but if we don't close above here, then I would say a short down to 138552 and maybe into this gap down here might be a good trade. All right, guys, that's been pretty much, I guess, enough for me. Thanks to everybody for turning up tonight. Cheers to Maud, Vicky, and the guys at the FX Street. Anything else, guys? Again, get me on Skype. Not Skype. What's it called? Twitter. You can get me on Skype if you want. Skype ID Steve Ruffley. Twitter at Steve Ruffley. Or just Google Steve Ruffley. I'm not a tough man to find. All right, guys, listen, been an absolute pleasure and happy trading. And like I said, take a screen print and see these levels work out for you. All right, guys, have a great night. Take it easy.